So we are halfway through this Introduction to Accounting course. You've been through one entire accounting cycle. As you know, that cycle begins with business transactions of one kind or another. That information is put into the books of the business, first the journal and then into the general ledger. And then that information eventually is put into financial statements. The balance sheet and income statements are the two we talked about. So we've been through that entire accounting cycle. But the cycle we looked at and the transactions we looked at were very, very simplified. And now we're going to take a look at some of the transactions, still using the journal and the ledger. But we will look at some of those transactions in a little bit more detail, a little bit more realistic detail. Yesterday and today, you had videos that talked about payroll deductions, and that's what this topic is about, payroll and how that's handled in a bit more detail than we looked at before. So we will take a look at how the accountant or the accounting staff would handle payroll transactions. On your screen, you see General Journal for the Mid-Ohio Farmers Market. This is the company you had on your quarter exam, actually. And you have on that page just one entry, and this is similar to one we had in a couple problems with the journal and the ledger in the last topic. You see that it's dated March 31, end of the month. Salaries, expenses debited, cash is credited. And this is a very simplified version, and now we're going to take a look at this entry and make it a bit more complicated for you. The videos I had for you yesterday and today dealt with the payroll from the employee's standpoint. It was assuming that you are the employee and you're looking at what happens on your paycheck, what the deductions are, and why they are there. Now we're going to look at the opposite side of that coin and look at the same kind of information from the business's standpoint. So when we talked about some of the deductions in the videos, you learned about federal state taxes, something called FICA, local taxes, and a number of other types of deductions that are possible. All of those are handled by the business for its employees. Now, this is not an optional thing for the business to do. The law says they have to do it. It involves a great deal of time and effort, and involves some of the accounting staff working full-time on nothing but payroll information, depending on the size of the business, of course. But the company will have to do this. So every pay period, this entry is made. And we're going to start with the one that's on your screen. Right now, I'm going to take out this part of the entry. We're going to leave the debit. At the end of the month, we're going to assume that the Mid-Ohio Farmers Market pays its employees monthly. We'll make it simple. We don't know how many employees there are. That doesn't matter to us for this entry. But let's assume at the end of March, we have salaries expense of $10,000. That's how much our employees earned for the month of March. So what happens next? One of the deductions that the business has to hold out of the employees' paychecks is something that we will put right here. Federal income tax payable. Now, how much do we withhold? Well, what that involves is much more complication than we need to get into right now, but there's a whole process of determining that. If you have a part-time job, you may be familiar with a form called a W-4, and that allows you to tell your employer basically whether you want to declare one exemption or zero exemptions. And that gets into how much will be withheld from your federal income tax paycheck, from your paycheck each day for the federal income tax. It gets a bit more complicated than we're ready for right now. So I'm basically just going to give you a number that will be credited, an amount rather. So we will say that this company for all of its employees withholds federal income tax for this month of $1,000. And again, there's a little bit more complication than we need to right now to explain where that number comes from. But a couple things that are important. This is an account that will be found in the ledger called Federal Income Tax Payable. Now, payable tells us it's a liability account, correct? Now, I need to stop just a second and explain to you one of the interesting aspects of accounting, and that is that there are sometimes exceptions to the rule. And the rule with liabilities has been, up till now, that when you incur a liability, you're gaining an asset in return. Well, this is the exception to that rule. There's something called federal income tax payable, and we'll see something called state income tax payable. And they are different kinds of liabilities. We're not getting an asset specifically, but much further along we'll see why that is the case. But at this point, it's just important for you to know that this is a liability account, and it increases on the credit side like any liability account. Now, we have withheld from our employees $1,000. It's not our money, it's their money, but that money we have withheld from their paychecks. We will have to pay it to the government, to the federal government, for them. And that's done by law, and not something that we necessarily would volunteer to do. But instead of the employees paying themselves, we are doing it for them. We are withholding the money from their paycheck, and eventually we pay that money for them to the federal government. So there's a lot of detail to that, obviously, that somebody in the accounting department has to keep track of. So that's part of this entry. We also have this account, and this also was described in the videos you looked at, state income tax payable. And there's another series of steps involved in determining how much will be withheld from employees for this. And let's just plug in a number for right now. We're not going to worry about how the 700 was arrived at, but suffice it to say, this works like the federal income tax. We withhold it from our employees. They owe it to the state. We keep it out of their paycheck. Eventually, we pay it to the state, and in our case, the state of Ohio, we pay it for them. It's actually their money, but we're withholding it, and we will pay it later for them. Another common deduction Oops, maybe I better spell that better, huh? FICA tax payable. And you're learning in your videos that FICA stands for Federal Insurance Contributions Act. And basically it covers two things. One is Social Security, one is Medicare. One is a retirement plan, one is a health plan, basically. Much more detail than that, but for right now we're looking at it simplified. And again, it's something that the government requires us to withhold from our employees. And there's a series of steps to determine how this amount is arrived at, but we will plug in $1,530 for now for this entry. So these are all liability accounts. They all increase. We owe more money. It's not our money. Actually, the employees earn that money, but we've withheld it from their paychecks. Eventually, we will have to pay it on their behalf. Okay, one more that we will look at. And this one really varies from area to area, from city to city. Some cities have this, some don't. But let's assume this city has an income tax, and again, it's a liability account that's withheld from the employees. It works the same way as the other liability accounts we just looked at. So the last part of this entry is finally a credit to cash. This represents the net amount that our employees get. They earned, if I can do this, they earned $10,000, but we withheld all of this money. If we add up these numbers and you subtract it from 10,000, you should come up with $6,570. So this is the total net pay. It's important to understand, again, for every transaction in the journal, you should know this from previous work, debits have to equal credits. Now there are 5 credits, but they add up to $10,000. So debits equal credits for this entry. Okay, so that is a typical salaries payroll entry that we will look at in more detail later, but it certainly is more detail already than you had in previous topics. The videos you looked at or listened to mentioned some other possible deductions as well. In some companies, there's a deduction from the money earned by the employees for health care. Maybe the employees have a 401k or some other savings method that is offered by the company. These sometimes are called fringe benefits. So when companies want to attract employees, they may say, we offer a health plan and you can get that health coverage as a payroll deduction, and we pay, meaning the business, we pay a percentage of it and you pay a percentage of it. So obviously the more money paid by the company, the better the fringe benefit. But that could be a deduction that we're not going to look at quite yet, but that's another one that could be part of this entry. Now, this is a monthly payroll entry for Mid-Ohio Farmers Market. So they pay their employees once a month. If this is a weekly paycheck earned by the employees, this entry would have to be made every week. So it would involve a lot of time and energy by a number of people to do that. At this point, I'll ask you to go back to your course page, and there are some questions at the bottom to answer after viewing this video.